How is everybody doing on this Saturday night, August 2nd, 2025? You are in the strategy room with the banker next door, your host, Dr. Joe Berquist. So I thank everyone for joining me here on this Saturday night. I hope everybody's having a good weekend so far. We got a lot and just a tremendous amount of stuff to talk about tonight. We've got Trump canning the head of BLS. We've got a whole bunch of tariff information. We've got the Fed's interest rate decision with dissenting votes. I got a lot to say about that. We got a very interesting jobs report, and as well as a plethora of other interesting stories and data, economic indicators, all the incredible things that I try to bring you here every week, week in and week out. But all right, let's kick off tonight with what I always like to do. Let's just check in on some of our U.S. debt clock here. So still hovering here at $37 trillion in the national debt, still hovering a little over $2 trillion in our federal budget deficit. Doge clock now up to $579 billion, equating to $5,162 per taxpayer. The GDP, debt to GDP ratio is still hovering very high at 123%. But very interestingly, we had the first Doge cuts last week that went through for about $9 billion. And I think the president this week was basically talking about, hey, should we start to give people like a $600 rebate check for some of those Doge cuts and some of the things that have come through? I'm not sure we really would like that or really need that. I would rather say I'd rather see the national debt get. I'd rather see some of this national debt get paid down. I think that would be a lot better use of that money right now at the moment. But like I said, we'll see what happens with that. So, okay. We're going to jump into a couple of the big stories here of the week. Obviously, this was great news. Our GDP kicked in this week, and the U.S. economy grew at a 3% rate in the second quarter, a better than expected pace, even as Trump's tariffs hit. Gross domestic product jumped 3% for the second quarter, better than the 2.3% estimate and reversing a 0.5% decline in the prior period. Consumer spending rose 1.4% in the second quarter. I'll have a little bit more information on that later. While exports declined 1.8% during the period, imports fell 30.3%, reversing a 37.9% surge in the first quarter. President Donald Trump responded to the GDP report with a fresh demand for the Federal Reserve to lower interest rates, and that continues to just get more interesting as we go along. So, just to read this real quick. So the U.S. economy grew at a much stronger than expected pace in the second quarter, powered by a turnaround in the trade balance and renewed consumer strength. The Commerce Department reported on Wednesday. Gross domestic product, a sum of goods and services activities across the sprawling U.S. economy, jumped 3% for the April through June period, according to figures adjusted for seasonality and inflation. That topped the Dow Jones estimate for 2.5% and helped reverse a decline of 0.5% for the first quarter that came largely due to a huge drop in imports, which subtract from the total, as well as weak consumer spending amid tariff concerns. They still have to put the tariff concerns in there. You got to love it. But anyway, financial markets react little to the report, with stock index futures mixed and treasury yields higher. The word of the summer for the economy is resilient, said Heather Long, chief economist at Navy Federal Credit Union. The consumer is hanging in there, but still on edge until the trade deals are done. Well, thankfully, those trade deals are getting done and coming in very nicely in certain respects. But like I said, we'll continue on here. I'll have more on that in just a minute. All right, let's talk about this very interesting jobs report for a minute. And I'm going to show you guys some other charts here after we go through this to kind of break this down. So the U.S. added just 73,000 jobs in July, and the numbers for the prior months were revised much lower. Now, obviously, the big thing here was not so much that we had 73,000 jobs in July. It was the fact that the jobs for the prior 2 months, for June and May, were revised much lower. So basically, it looks like for the last 3 months, job growth was very muted, basically little to none. And then that obviously will lead to our next story here of why Trump got rid of the head of the Bureau of Labor Statistics. But before we get there, Non-farm rolls growth totaled 73,000 in July, above the June total of 14,000, but below even the meager Dow Jones estimate for a gain of 100,000. June and May totals were revised sharply lower, down by a combined 258,000 from previously announced levels. Now, that's what you call a massive correction. And it gets to the heart of what I have been asking for the last 2 years here, is that what is going on with the Bureau of Labor Statistics? We had this big revision of 818,000 jobs last year that they said existed, and then it turns out they didn't exist. We've got another revision that's going to hit in February that's going to show that probably about 1 million jobs from 2024 didn't exist. So, you've got about anywhere from 1.8 to 2 million jobs that just didn't exist, that they just completely overreported. And here we go again. They're coming in with these numbers, and now we're getting these revisions much lower. It just begs the question, what's going on over there? Can they not count? Is basic mathematics not part of the job requirements over there at the BLS? It's just, and again, this isn't something that just happened this month with this jobs report. This is something that I'm sure people had been pointing out to the president. I think it's just something that came to a head yesterday after these numbers came out, and I think a lot of people online were just going, what is going on? What is happening over there? So anyway, but let's continue here for a second here. So the week report included that dramatic revisions could provide incentive for the Federal Reserve to lower interest rates when it next meets in September. Healthcare and social assistance combined for some 94% of the job growth. So non-farm payroll growth was slower than expected in July, and the unemployment rate ticked higher, raising potential trouble signs for the U.S. labor market as President Donald Trump ramps up tariffs. Job growth totaled a seasonally adjusted 73,000 for the month, above the June total of 14,000, but below even the meager Dow Jones estimate for a gain of 100,000. The Bureau of Labor Statistics reported Friday June and May totals were revised sharply lower, down by a combined 258,000 for previous announced levels. At the same time, the unemployment rate rose to 4.2%, in line with the forecast. The June total came down from previously stated 147,000, while the May count fell to just 19,000, revised down by 125,000. And we could see again, and this is what people are looking at here. If we look at this chart to the far right here, the 3 most recent months, you can see job creation figures for May and June were revised significantly down by more than 250,000 combined. And then we just had the 73,000. So you can see here for the last 3 months, that at least according to this, that job growth has not been, very good at all. Stock market futures fell further after the news, while Treasury yields were also sharply lower. This is a game changer jobs report, said Heather Long, chief economist at Navy Federal Credit Union. The labor market is deteriorating quickly. The week report, including the dramatic revisions, could provide incentive for the Federal Reserve to lower interest rate when it next meets in September. So we'll see what the Fed does here in a second. But let's go back to. Let's go back to X here for a second. I just want to show you guys a few charts here. So I'll get here because I got some interesting things to show you guys first. So this, and let me make this a little bit bigger here so everybody can kind of look at this. Here we go. I think that's a little bit better. Okay. Congratulations to Powell and Company, who have officially lost more than $235 billion, while also creating a veritable palace for themselves in the Eschels building. Your tax dollars at work, or missing, or something. But yeah, that is, some people will say a picture is worth 1,000 words. Well, the picture of this chart here is quite amazing. It's quite astonishing. You would think that the press would just be hammering Jeremy Powell with questions on this nonstop. Why have you lost $235 billion in the last 2 years? Do you think there's a chance you could turn that around? Any chance you might be able to get, maybe back to making some money again? But no, totally silent. When we have these when they have their press conferences and they give their little speeches and stuff like that, nobody asks them about this. This is just like it's just not happening. Like it just doesn't exist. And people are like, why would you question the job that Jeremy Powell is doing right now? If anybody ever asks you that question, all you have to do, you don't need to say a word. You don't need to say a word. You just hold this chart up. Just hold it up and just let it sit there. And just here you go. Here you go. I don't need to say a word. You want to talk about job performance? Here you go. Okay. I just want to say this for a second. Imagine, if you will, that this was the stock for any Fortune 500 company, I don't care who it is. Imagine that's a chart of their stock price right there. That's a chart of their profits. Does that CEO still have a job at the end of that call? Like, no, they don't. They're gone. They are gone. Yeah. So it's amazing. So, but anyway, I digress. All right, hold on. Something happened here. I got, all right, let me go back to, all right, we're going to talk about this here in a second. Adrian Krugman. Oh, wait a minute. No. Yeah, so this was other breaking news that just happened last night. So Adrian Kugler submits resignation as a member of the Federal Reserve Board effective August 8th, 2025. So the Federal Reserve Board announced on Friday that Adrian Kugler will step down from her position as governor of the Federal Reserve Board effective August 8th. Dr. Kugler, who has served as a governor since September 13th, 2023, submitted her letter of resignation to President Trump and will return to Georgetown University as a professor this fall. The text of the letter from Governor Kugler is attached. So again, very interesting. Some more very interesting news that we were not, expecting, that came hot off the presses yesterday very late in the day yesterday. But Trump will get to appoint the person that takes her spot, which again makes this very interesting given the current environment and what's going on. Okay, here's an interesting chart from EJ Antoni. Had to extend the graph in both directions for June because Washington, D.C. lost so many jobs while states like Idaho gained so many. What a difference public policy makes. And you can see at the very top here, we got Idaho with this red line adding a ton of jobs. And then at the very bottom, you could kind of see if I can blow this up a little bit more here. Yeah, it might be a little bit better there. So you can see, Idaho here at the top, you can see they're adding a ton of jobs. Utah, South Carolina, Florida, Texas, North Carolina, adding a lot of jobs, which is great. And then you can see here, Washington, D.C., very much not growing at the moment, which is fantastic. So that's good. Here is U.S. tariff revenue annualized, like I keep talking about here. So preliminary June estimates would take this up to about $360 billion right here, which is fantastic, phenomenal, absolutely phenomenal. Keep it rolling. Let's see here. Interesting news. Charles Schwab has emerged as the dominant broker post TD acquisition, with over 60% of recent retail trades now routed through the platform. So that's kind of interesting news there. Another interesting chart here from EJ Antoni, and I'm going to make this one a little bit smaller. Despite the loss of full-time jobs in July, there are still almost 1.2 million more people employed full-time today than a year ago, while part-time work is up almost 700,000 jobs. So you can see there, that is great news. So 1.2 million people having full-time jobs. That's 1.2 million more people having full-time jobs right now than there were a year ago. Part-time jobs are up 700,000. So again, and again, I'm going through this series of charts here with everybody because I want you to see some of these things. All right, that's all right. Hang on a second here. I'm going to do something here. I'm going to go back. I got to go back here for a second. All right, let's go. Because I had some other charts here that this get all out of whack here. Yeah, of course it did. Here's Here's another chart from EJ Antoni. So jobs in the federal bureaucracy fell again in the July jobs report, now down every single month this year. Thank you, Doge, and down a cumulative 77,500 this year. So that's good. It's a decent start. We still got you got millions of employees in the federal government, so it's a nice little kick, but it's not, still barely making a dent. Federal workers down for the 5th month in a row. That's good. Oh man, I'm not seeing. Oh, here we go. Okay. Yeah, massive native-born jobs are skyrocketing. Foreign-born jobs are plummeting. In the last few months, native-born jobs plus 1.8 million, foreign negative 1.5 million. So the lost jobs belongs to criminal aliens. You shouldn't have had them. I voted. Okay, maybe so. But yeah, just I think, again, a good trend. This is just showing that jobs are going back to U.S. citizens versus illegals, basically. All right, let's see here. I was looking for. All right, there was. Yeah, and again here, another chart here. And again, this is just digging into this jobs report here. So employment among native-born Americans exploded over the last 12 months, up 2 million, while foreign-born workers with jobs fell 273,000. All net job growth over the last year went to native-born Americans. So just absolutely fantastic numbers. So, all right, well, let me get back to some of this other news here. So because all I wanted to do there was I wanted to dig into the jobs numbers a little bit, just because I wanted to show people that, it's not all bad. There are some very good things there. We're obviously seeing that the trend has reversed of all the jobs, literally almost all the jobs going to foreign-born workers, now going back to Native American citizens. So that's fantastic. That's fantastic news. You see the number of full-time jobs going full-time employment getting better, part-time jobs continuing to go up. So again, great signs, but we just got to figure out what is going on here with the Bureau of Labor Statistics and what is happening with their reporting of these numbers, because it's just bonkers. It just doesn't make sense. It's so crazy. It's so out of whack. And then that is a perfect segue here to, Trump fires Commissioner of Labor Statistics after weaker than expected jobs figures slammed market. No, he did not fire her because we had weaker than expected numbers. He fired her because we have a long-term trend of a couple years of the numbers just being so manipulated and so all over the place. Why she was still there 6 months into his administration, I have no idea. She should have obviously been canned his first day in the White House, but she somehow managed to hang on there, which is just beyond me. But anyway, but this is where we're at. But anyway, President Donald Trump on Friday fired Bureau of Labor Statistics Commissioner Erica McIntyre hours after the agency reported that job growth in the U.S. had slowed to a near halt. We need accurate job numbers. I have directed my team to fire this Biden political appointee immediately, Trump posted on Truth Social. The stunning move came the same day as the BLS reported a gain of just 73,000 non-farm jobs in July, below market expectations. No, the firing came because there was an outcry on social media where people were saying, what is going on here? This doesn't make any sense. These job numbers they're all over the place. We get these reported numbers, and then the next month, it's way down. And then a couple months go by, and then we get revisions that go further down. And then we find out there's hundreds of thousands of jobs that never existed and got counted and stuff like so. So there, the BLS has been a mess for a couple of years, and it's time that somebody got in there and cleaned it up. So I was happy to see this. Again, we'll see what happens with some of this reporting of job numbers over the next few months, but I hope that this leads to a positive outcome. Okay, and it just basically just goes on to say, this was a Biden appointee, whatever, blah blah blah. I just feel that this article is very misleading here, because it tries to make it sound like, he just fired her because he got a lousy job number and he wasn't happy with that, so he canned her. And it's like no. And again, anybody who's been watching the live stream or watched a lot of the videos that I have done reports on over the last 2 years of the jobs reports, I have reported on numerous occasions how these numbers have just been all completely crazy, completely out of whack, completely all over the place. That it's not, again, is it typical to get revisions in some of the job numbers, from a month to month basis? It is. Is it, but are you seeing these? Do you get reports on a 6 month basis that were like, oh, yeah, there's 800,000 jobs that were counted that never existed? Oh, yeah, we went back and we just revised it back down another 200 and over 250,000 jobs. No, that is not normal. That is not normal at all. And that should not be happening. I mean, that just smacks of gross incompetence. And so so again, don't know what's going on there, but I'm glad that they finally did something, and we'll see if this can get fixed here. So we'll go on there. But okay, let's turn our attention now to the Fed meeting that they had this week. FOMC met this week, basically decided not to reduce interest rates. So but there were some very interesting things that happened. If you were listening last week, I was basically saying that, hey, Mickey Bowman, Waller, you guys, you talk the talk, but let's see you walk the walk. And what I wanted to see dissenting votes. And boy, they did not disappoint. They delivered. They delivered with the dissenting votes indeed. But before we get to that, I want to show you guys just a couple articles here. So this first one was from the Wall Street Journal, and this basically said a divided Fed eyes future rate cuts but won't move this week. Officials are still split into three camps over what economic evidence they need before resuming rate cuts, with two governors preparing to dissent. Federal Reserve officials are divided over when to resume lowering interest rates after pausing earlier this year. Some Fed officials want to cut rates now, while others want to wait for more data. Political pressure from President Donald Trump adds to the debate as the Fed weighs inflation risks versus economic weakness. So we got that, but then let's go to this. Fed governors could break ranks as Trump intensifies Powell pressure. Possible dissents by Christopher Waller and Mickey Bowman would mark the first time in 3 decades that more than one Fed governor dissented at a policy meeting. Now, I've talked extensively about Dr. Thomas Honig and his dissenting votes back in 2010. That was the whole purpose of the book, The Lords of Easy Money, which I have covered. But the last time, and this is why I wanted to point this out, the last time that we had a Fed meeting where we had multiple governors dissenting, it was a situation that has not been seen since 1993. So this week's Fed meeting could produce something that hasn't happened since 1993, more than one governor voting against the Fed chair. The groundwork was laid weeks ago. Welcome to monetary policy in the age of succession campaign. Fed Chair Jeremy Powell and his colleagues have signaled they favor maintaining a wait-and-see approach at this week's meeting. The potential dissenters, Governors Christopher Waller and Mickey Bowman, happen to be President Trump's two appointees. Both have voiced support for cutting rates, which Trump also has publicly demanded. Their break with Powell coincides with Trump intensifying his pressure campaign against the Fed chair, from surprise visits to the Fed to public attacks on the chair's leadership, all while potential successors jockey for a position ahead of Powell's term ending next May. The last time more than one governor dissented in a single meeting was more than 30 years ago, a streak that includes 259 policy meetings. So that obviously came to an end this week, that streak. But I just wanted to point out that it has been a very, very long time since we got multiple Fed governors dissenting in a meeting on interest rates. Because, again, not to get too far into the Lords of Easy Money discussion, but if anybody saw that, one of the big things that came out of that whole book and that whole discussion was the culture of the Federal Reserve, and basically how it's a culture that, usually the Fed chair is, very the Fed chair does not want dissenting votes, and they are very, very demanding behind the scenes in terms of, hey, you need to get on board. You need to toe the party line. Everybody needs to be, rowing in the same direction. But as you know, Jeremy Powell has turned into a lame duck. I mean, he knows he's got less than a year left. He knows he's not going to go back. You've got a couple people basically vying for his job. So, is it any surprise right now that you would end up with a couple dissenting votes at this point? Like, no. But like I said, just wanted to point this out. So then we get to Fed governors Bowman, Waller explain their dissents, saying waiting to cut rates would threaten the economy. So two Federal Reserve officials who voted this week against holding a key interest rate in place explained their decisions Friday, both indicating that the central bank is making a mistake by waiting to ease policy amid rising threats to the labor market. Governors Christopher Waller and Michelle Mickey Bowman both said they wanted a 0.25% point reduction as they see tariffs having only a temporary impact on inflation. They said staying on hold, as the rate-setting FOMC has done since December, poses risks to the economy. In separate statements, Waller and Bowman laid out their reasons for dissenting. The first two governors have done so since 1993. The committee voted 9-2 to hold, and the differences of opinion reflect a healthy and robust discussion, Waller said. The pair released the statements just prior to the Labor Department report on job growth. There is nothing wrong about having different views about how to interpret incoming data and using different economic arguments to predict how tariffs will impact the economy, Waller wrote. But I believe that the wait-and-see approach is overly cautious and, in my opinion, does not properly balance the risks to the outlook and could lead to policy falling behind the curve. Further, Waller insisted that inflation impacts from President Donald Trump's tariffs have been small so far and could continue in that vein. Both he and Bowman, Trump appointees during his first term, did not advocate for the kind of dramatic cuts Trump has pushed. The president has suggested the federal funds, which sets a target rate that banks use for overnight lending, but spills over into many other areas, should be as much as 3 percentage points lowers. Waller suggested something more gradual, cutting by as much as 1.5 percentage points at a slow pace as the committee monitors impacts from policy easing. Similarly, Bowman backed gradual cuts, as she also said tariffs are having only limited impact on prices. In fact, she said that without the duties, the Fed's key inflation measure would be below 2.5% and considerably closer to our 2% target. So again, there you have it. So basically, they're sitting there, and I believe I concur wholeheartedly with what Waller and Bowman are preaching here. Do I think we need 300 basis points and rate cuts? No, I don't, and I wouldn't advise that because, if you cut 300 basis points, you're almost taking us back down to zero, and that's a dangerous place to be. We don't want to go back there. We don't want to go back to zero interest rate policy. That's not where we want to be. And the other thing you have to consider is that if you dramatically reduce rates that far down and something happens, in other words, if we get into a recession or we get into a bad period, and you have to try to do something to help the economy. Well, if it's at zero, there's nowhere to cut. If there's nowhere to cut, there's really nothing you can do. I mean, you could go negative, but that's a horrible idea. We actually have examples of that in the last 15 years, and we saw how that worked out for Japan and for Europe. It was horrible. It didn't work out at all. So you don't want to do that. However, I believe the trick here is to get rates down by 100 to 150 basis points. I really think that that's the sweet spot. If you could take that federal funds rate from 4.5 down to 3%, and leave yourself a little bit of room in case something happens, so that you could further cut rates a little bit more. I think that would be a great spot to be. I think just 150 basis points, and if the Fed just did that in 0.25 point rate cuts, every meeting, if they started September, because you remember you only have 3 meetings left in the year. You have September, October, and I think this year is November. I don't think they have a December meeting this year. Usually November, December, you only have 1 meeting, and it just kind of depends on how the dates fall with the holidays and all that. But they only have 3 more meetings left this year. And I would say, September, October, November, if they could cut 0.25 basis points, that'll take us down 75 basis points for the year. And then as you get into next year, you could go January, February, March. and you could do a couple more quarter point cuts, then that takes you down 150 basis points. I think gets you right where you need to be. And then I think over the next 6 months, you just sit back and you just see what happens, see how it goes. If things aren't going well, or if inflation starts to reignite, you can always, bring the rates back up a little bit. So, but I think that should be the plan of the Fed. Now, again, whether or not that happens or not, I don't know. I mean, Jeremy Powell is just hell bent on, he is not going to budge an inch, and not going to drop those rates. But let's go to the official announcement here for a second. So I just want to, let's just go here. So the federal funds target remains at 4.25 to 4.5%. The market's reaction, not really much. I mean, S&P 500 went up a little bit. U.S. 2-year and 10-year treasuries were mostly unchanged. So the market did not have a giant reaction to this. The big news was obviously the 2 dissenting votes by Waller and Michelle Mickey Bowman. Fed continues to state the uncertainty of the economic outlook by stating it remains elevated. Whatever. We have made no decision about September. The Fed will continue reducing its holdings of Treasury securities, agency debt, and agency mortgage-backed securities. So in other words, they're going to continue to bring down the balance sheet at the Fed. They're going to, they've brought it down to about 6.7 trillion. I did have, I can't find that chart, or I could not find that chart a few minutes earlier. I wanted to show you a chart from EJ Antoni, who put up a really nice chart showing the Fed's balance sheet and basically showing how, hey, they've done a decent job of bringing it back down from the almost 9 trillion it was at down to about 6.7 trillion, but it's still like at a 58% higher than where it was pre-pandemic. Because, prior to the pandemic, I believe their balance sheet was probably at about $4 trillion. And then the pandemic hit and it just, totally ballooned up to about 9 trillion. So again, they're going to continue to to bring the balance sheet number down a little bit. And that kind of plays in big with repo, the repo market with repos with reverse repos. And we'll have to see what, happens with that. But, reverse repos are getting down pretty low, and that's not good for market liquidity. So, but like I said, I'll get into that another time. But let's look at the Fed statement here for a minute. So, although swings and net exports continue to affect the data, recent indicators suggest that growth of economic activity moderated in the first half of the year. The unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate. In support of its goal, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So now let me just say this. Let's look at this last sentence for a second. The committee's assessments will take into account a wide range of information, including readings on labor market conditions. Hello, what about this right here? Okay, and now again, I know the jobs report came out after the FOMC had their meeting, but I would venture to say this: if the job numbers are weak heading into the September meeting, like in other words, if we get weak numbers, because they probably won't meet in September until probably around September 18th, 19th, something like that. So if we get job numbers for August and say maybe we have some further revisions, whatever. But if August job numbers come in looking weak like this, where is the rationale? Like, and again, if we see the inflation numbers over the next, month and a half, if we see the inflation numbers continue to come down, where is the justification? Again, I feel that Jeremy Powell is just, he's out of bullets at this point for his justifications for why not to reduce rates. I mean, this is, and again, if these numbers hold true here, again, we have a weak labor market. And again, we're just going to their own statement. Their own statement here says a wide range of information, including readings on labor market condition, inflation pressures, and inflation expectations. So, if inflation's coming down, if the labor market is weakening, then where's your justification for keeping rates higher? That's my question. And all of the Chicken Littles out there that basically said, "Oh, the tariffs are coming in. The tariffs are going to crash everything. It's going to be the end of the world. The stock market's going to crash. Everything's going to fall apart." I mean, even for people who watch and pay attention, Bill Maher, obviously he's had his own show on HBO for a long, long time. Even Bill Maher he came out this last week and basically said, "You know what? I was wrong. I thought that the tariffs were going to wreck the economy, and it's actually worked out fantastic." When you have people like Bill Maher admitting that he was wrong about the tariffs, then that pretty much tells you where it's at. So which is the argument is just incredibly weak right now for the fact of these guys sitting here saying, "Yeah, we're just going to sit here and just not do anything at all." So all right, well, so we're going to keep an eye on the next, obviously month or so, see what happens with this. Obviously, we're just continue to get more and more developments with I go back to, the Fed. I go back to this. Let me pull this up. Obviously, Fed Governor Adriana Kugler resigning last night. I mean, obviously, this is a big thing here, and we'll have to see what happens with this as we continue to go along. Trump is going to get to appoint this governor here, whoever this individual ends up being. Obviously, if you have, again, the press has done such a lovely job of pointing out that Waller and Mickey Bowman were, Trump appointees, and, they're voting along with Trump and everything. So, well, you're going to get another person here now who's going to vote along with Trump. So that'll be three people that will continue to basically hammer Powell. And I would say, what is Jeremy Powell going to do here? Because, I think basically he's got, again, his term doesn't end until May of next year, but he's only got, realistically, he's got a couple months left, because I would say come September, October, they're going to appoint the person who's going to take his job. So then once that person's there and in the meetings, Trump, or not Trump, but Jeremy Powell just becomes even more of a lame duck. And then you get a third person here voting against him. I don't think that he is going to be able to hold out for much longer and basically continue just not doing anything. I just don't think that he's going to be able to do that. But we'll see. Maybe he will. Maybe he will be defiant until the very end. It's even funny, it's almost poetic about the thing is that they made a big deal about Waller and Bowman being the dissenting votes. Yet in reality, the biggest dissenter is Powell himself. Like, he is the one dissenting against the will of basically everything, and not wanting to reduce rates, which is very, very interesting if you think about it. So, anyway, all right, let's, and then one last thing here on the Fed here before we move on to tariff stuff. So I thought this was really interesting. So this company was actually suing the Fed, and they actually got a meeting here in front of a judge because they wanted the Federal Open Markets Committee meeting to be open to the public. And basically they wanted, everybody to basically be able to see what was going on. Which, again, I don't necessarily disagree with. Why don't we have more transparency from the Fed? I think is a great question there. But of course, the court denied them and basically said, no, we're not going to do it. But the article here is titled, Judge Rejects Bid to Open Fed's Closed Door Meetings on Interest Rates. The ruling denies Azoria Capital's emergency request, but leaves the broader lawsuit alive, with the plaintiff vowing to keep fighting for transparency. So again, I just thought this was interesting. So a federal judge in Washington has rejected an investment firm's request to force the Federal Reserve to open its closed door monetary policy meetings to the public. U.S. District Judge Beryl A. Howell on July 28th denied Azoria Capital Inc.'s request for an emergency order requiring the Fed to hold its upcoming interest rate deliberations in public. Azoria Capital sued last week, arguing that the central bank's decades-long practice of holding FOMC sessions behind closed doors violates the Government in the Sunshine Act. That law generally requires multi-member agencies to allow the public to attend their meetings, a standard Azoria claims the Fed failed to meet, subjecting the company to irreparable harm. So again, very interesting. So we'll see what happens, if anything, with this lawsuit, and if this ends up going anywhere at the end of the day. But again, just very interesting. I thought it was very interesting. I never really seen anything like that before, and the fact that they did get this in front of a judge, and unless if the judge had not ruled, they basically would have been. If the judge had ruled in their favor, the Fed would have been forced to open this meeting up to the public, and that would have obviously that would have caused some utter insanity. But you just see people at Bloomberg and CNBC losing their mind. Jim Cramer might have it might have been a bad day for Cramer over there. But anyway, he would have. I need that meme. They know nothing. They know nothing. All right, let's talk some trade deals here. Okay, this is fantastic. So the U.S. and the EU reached trade deal. Key takeaways. This is probably the biggest deal ever reached in any capacity, Trump said. President Trump announced on July 27th that the United States reached a trade agreement with the European Union after months of tough negotiations. Before meeting with European Commissioner President Ursula von der Leyen, Trump told reporters that there was a 50-50 chance of establishing a deal. European leaders had prepared for a no-deal situation ahead of the August 1st deadline. Ultimately, both sides of the Atlantic agreed on a framework that would facilitate $1 trillion in annual trade, accounting for 1/3 of global commerce. So here are the key takeaways. So tariffs. The United States will impose a 15% tariff on most European goods. The 15% is not added to existing tariff regimes. While this is lower than the president's previous proposal of 30 to 50% levies, it is higher than the 10% baseline tariff unveiled on April 2nd. We're doing them on the low end, not the high end, because we don't want to hurt anybody, Trump said. This is probably the biggest deal ever reached in any capacity, trade or beyond. It's a giant deal with lots of countries. Moving forward, the United States and the EU will establish a 0-for-0 tariffs on several products, including aircraft and their components, semiconductor making equipment, certain chemicals and pharmaceuticals, and natural resources and critical minerals. Several agricultural products will be exempt from tariffs, including beef, ethanol, poultry, rice, and sugar. The automobile industry will also experience relief as import taxes are set to decline from 27.5% to 15%, mirroring the rates Japan received last week. European steel will be subject to 50% levies, but Brussels and Washington are discussing the creation of a quota system. Investments, like other recently announced trade deals, the EU will be making massive investments in the United States over the coming years. The EU has committed to invest $600 billion in the U.S. economy. The 27-member bloc will also purchase $750 billion worth of U.S. energy products, including liquefied natural gas, nuclear fuel, and crude oil over the next 3 years. Aligning with NATO's defense spending goals, the EU has pledged to purchase hundreds of billions of dollars in U.S. military equipment. And then non-tariff trade barriers, in addition to tariffs and investments. The U.S.-EU trade deal addresses important non-monetary trade barriers. We do cover quite a bit of ground in this agreement, and we expect this great impact on reducing our deficit and trying to increase U.S. exports to the European Union. Again, just fantastic. So what's next? The latest trade blueprint will require the approval of EU member countries. Ambassadors are scheduled to meet on July 28th for a debriefing from the European Commission. This will enable all member states to break down technical discussions and refine additional details. Details have to be sorted out, and that will happen over the next week. Von der Leyen said at a press briefing shortly after meeting with Trump, this is something which has to be sorted out in the next days. Investors shrug off the deal. Yeah, no, they loved it. Yeah, they loved it. And I want to, if I can find this from Peter St. Unge, who has a great doctor. Yeah. Let's see here. Well, this was on, Peter St. Unge is fantastic. If you've never seen his podcast, I highly recommend it. He does a lot on X, puts out a lot of little 3-minute blurbs. Let me see if I can find his post real quick on the deal. It was funny. All right, let me see here. I'm not. Oh, here we go. Yeah, here it is, right here. So, so you gotta love this. Love it. Trump steamrolls Europe. Europe just signed a trade deal so one-sided you think it was drafted in Mar-a-Lago with a Sharpie. It wasn't a negotiation, it was a mugging. Brussels handed over its wallet, PIN code, and offered to buy Trump lunch. Fantastic. Oh, you gotta love it. Oh, baby. I love it. I love it. I love it. Let's see here. Going to the next thing here. So Trump secures key trade agreements ahead of the August 1st. Here's what we know. So I just like this just because I want to do a quick rundown. Obviously, we've got deals so far with the United Kingdom. We've got deals with Vietnam. We've got deals with Indonesia. We've got deals with the Philippines. We got deals with Japan. I thought we had a deal with India, but that has just blown up. But obviously, so these deals are coming in, and these deals are fantastic. And the tariff revenue is just starting to rev up, and it's fantastic how much tariff revenue that we've got coming in the door right now. So, and then obviously the other big trade talk of the week was U.S. and China resume trade talks. Here's what we know. Now, I have been saying for many months now that I think the trade talk with China is perhaps the most complicated trade talk of anybody else that we deal with. And we kind of got through just a first phase because the rare earth materials were extremely critical and important to what we were doing. So we needed to get that. We needed to get that stuff back in. So we worked out kind of what I would call phase 1 of a trade deal. Now they're back working on phase 2. And these trade deals with China, these negotiations, they are going to get tougher as this goes along. There's no doubt about it. I mean, they are going to get tougher. And I think, and this is the big one to me, China is the big, enchilada here. So, but what were the key takeaways from this week's meeting? Well, representatives of the U.S. and China are meeting in Stockholm on Monday and Tuesday to extend a trade truce. U.S. tariffs on China are set to be ratcheted back up to 145%, a virtual trade embargo if a deal is not struck by August 12th. President Donald Trump has demanded that China crack down on fentanyl smuggling, among other things, as a condition of lowering tariffs. China has retaliated against American tariffs with its own import taxes and cut off the U.S. from rare earth minerals used in advanced manufacturing. So again, they're just starting these talks. They have to try to reach a deal by August 12th. We'll keep an eye on this over the next couple of weeks and see what happens here. My guess is they will be able to work something out here and probably extend the deadline another 90 days. But we'll see what happens with that. We'll keep an eye on it. One thing that's very interesting, and I think this is China showing their hand a little bit. So, and I wish I had this. I wish I could find. This is one article I couldn't find before I came on tonight. So, but China basically passed a new law that has to do with intellectual property, and basically what it is they're forcing companies. Like if you come into, they already forced companies to turn over a lot of intellectual property if you wanted to do business in China, but now they're taking it to another step, and they're basically coming in and forcing these companies to hand over their intellectual property if they want to continue making their goods in China. they're obviously doing this because they're looking at things and they're going, okay, our dominance over manufacturing is probably going to be, again, they make too much stuff for it to come to an end overnight or in the next couple of years, but their dominance as the manufacturing powerhouse all over Asia in the world, people basically just sending the cheap stuff to them to make is probably coming to an end sooner rather than later. Not that they're not still going to do a tremendous amount. They are, but I'm just saying they're complete. The dominance that they've enjoyed for the better part of the last 20 years, that is probably not going to last. And so they are basically going to go on, they've gone to like a scorched earth policy of, hey, let's grab as much IP from these companies. Let's blackmail these companies into giving us all their IP right now, before this trade deal comes in and either takes this business away from us or prevents us from doing that. So, just like I said, just an interesting caveat I saw there. All right. Some other interesting things this week. So Trump extends Mexico's 25% tariffs for 90 days as talks continue. So President Donald Trump said he would not raise U.S. tariffs on Mexican goods beyond their current level for 90 days. Trump recently threatened to raise the blanket tariff rate on Mexican imports to 30%. Trump also said that Mexico has agreed to immediately terminate its non-tariff trade barriers without specifying which. So again, ongoing trade talks continue with Mexico. They continue with Canada. We had some interesting Canadian news that came out. Then we also had this. Trump announces 25% tariff on India plus penalty for trade with Russia. So President Donald Trump said that India will have a 25% tariff beginning August 1st, which was obviously yesterday. He also said that the key trading partner will face an additional penalty, but did not specify what that might mean. Remember, while India is our friend, we have over the years done relatively little business with them because their tariffs are far too high, among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country, Trump wrote on Truth Social. So what looked like we had pretty much a deal worked out with India has now kind of, rolled itself back. They also want to basically penalize India for basically doing business with Russia. I mean, that's part of what President Trump is trying to do now is basically he's trying to leverage these trade deals with these other countries like Iran and Russia to basically stop them, or I should say with India, like Iran and India, basically trying to cut off certain trade routes and monetary supplies for Russia through some of these trade deals that he's working on. So we shall see, what happens with this. But like I said, we'll keep an eye on it as this stuff continues to unfold. Also, Trump slaps universal 50% tariff on copper imports. Metals price plunges. So President Donald Trump has signed an order imposing a universal 50% tariff on copper. The White House says the new duty takes effect on Friday, the same day his reciprocal tariffs and other duties are set to restart. The copper tariffs follow the 50% UF tariffs on steel and aluminum that Trump previously imposed. So now, part of this is like a national security issue with these tariffs. So we'll have to, again, like so many other things, we'll have to continue to see what happens with these and what goes on there. So, and then I wanted to share this with you. I think this is my last tariffs article here. So, U.S. goods trade deficit shrinks in June. So the U.S. economy is projected to surge by more than 2% in the second quarter. So let's go down here. So U.S. trade deficit in goods narrowed in June as imports declined, fueling expectations of a sharp second quarter GDP rebound, which we obviously got. I reported on a little earlier here. The international goods trade gap declined by nearly 11%, or $10.4 billion to $86 billion, according to new Commerce Department data released on July 29th. In May, the U.S. goods trade deficit increased to a slightly downwardly adjusted $96.5 billion. The consensus forecast suggested a 98.4 billion trade deficit in June, with economists expecting further stabilization in trade flows following the upheaval in worldwide trade flows in April. Goods imports fell by 4%, totaling 264 billion last month. Exports of goods for June were little changed at 178.2 billion. Market watchers are paying close attention to imports, as they will likely be a substantial factor in the coming quarterly GDP reports. Imports are subtracted from gross domestic product calculations, since those calculations measure the value of goods and services produced domestically. So again, I think some good news there on U.S. goods trade as it shrinks in June. So again, more good stuff. So just to recap real quickly on the trade stuff. So got a major deal with the EU, major deal, which was phenomenal. Still trying to work out deals with Mexico, Canada. Canada keeps just doing stupid stuff. We got the tariff on copper, which again is more of like a national security issue. So I'm not necessarily as concerned with that. U.S. goods trade deficit shrinks in June, and obviously the India trade deal is still not, that was a little, that one was a little unsettling how that blew up the way that it did. Because again, we'll have to see what happens there. But obviously India really needs us as a trading partner. They would benefit greatly by doing a lot more business with us. That is for sure. Would help their economy and their country a lot. So I would have a hard time believing at the end of the day that they would not want to come to some kind of deal with us. And that's not even, we're not even getting into the whole H-1B visa thing yet, but we'll get to that in a little bit here. So, all right. Okay, before I jump into a lot of these other articles and before we get into the open banking thing here, so I'm going to go a little early. So this is usually the segment of the show where I talk about the episodes that I put out this week. I also like to talk about what economic indicators do we have coming up this week. So I'm going to get into all of that real quick. So let's go. What economic indicators do we have coming out this week? So on Monday, August 4th, we get factory orders. Tuesday, August 5th, we get trade balance, services PMI, ISM non-manufacturing PMI, the 3-year Treasury note auction, API weekly crude oil stock. On Wednesday, August 6th, we get the 10-year Treasury note auction. On Thursday, August 7th, we get continuing jobless claims, initial jobless claims, non-farm productivity, consumer credit, Fed's balance sheet, and then finally on Friday, August 8th, we get the U.S. Baker Hughes oil rig count. So a little bit. So yeah, I mean, there's some economic indicators there, not necessarily like a lot of the major stuff that we normally like to see. So a little bit lighter there on the economic data here coming in August, as it's kind of expected for this time of year. Things get a little bit lighter as we get into like vacation season here. But okay. So what episodes did I put out this week? All right, so I had 5 episodes come out this week, Monday through Friday, as I normally do. On Monday, I did episode 434, which was an interview with White Clay founder and president Mac Thompson. Mac was great. I really appreciated him coming in and doing that interview. So what do we talk about? So we discussed how White Clay software helps banks and credit unions maximize profitability within a product or business unit. How you can fully utilize existing data to build stronger relationships with your customers, how White Clay can help with balance sheet management and thus strategic planning. And we also discussed Mac's background and why he decided to start White Clay almost 20 years ago. So that was my interview there with Mac Thompson. If you haven't got a chance, check that out. It was really good. Then on Tuesday, I did episode 435, which was a review of ICBA's advocacy in action for the third quarter of 2025. This episode examined ICBA's advocacy in action, which I love. It's just a little 2-page PDF, really hits all the regulatory hot button issues at the moment. So this report covers all of, like I said, the hot button regulatory issues in the banking industry, issues Covered include digital asset regulatory framework, trigger leads, challenges to the 1071 rules, support for agriculture, taxation of larger credit unions, ICBA check fraud task force, the Section 1033 rule, also known as the open banking rule, CRAs, Community Reinvestment Act, GSEs, and the federal home loan banks. So again, I love that because I got a chance to kind of cover all the regulatory hot buttons going on out there at the moment. So check that out if you just want to get a quick, that episode's great if you just want a quick overview of what's going on regulation wise in the banking industry. Just check that episode out. That's why I do it, because it's real quick and dirty. Okay, Wednesday, episode 436 came out, and that was called The Next Generation Monetary and Financial System. Now, this was the 26th installment of the crypto series. Now, this particular episode was really interesting because I did this on a Biz report. So this was part of the Biz is the Bank of International Settlements over there in Switzerland, the Tower of Basel, as some know it. But this was part of the Biz Annual Economic Report for 2025. And this was Section 3, which was called the Next Generation Monetary and Financial System. So this report considers how tokenization, that's a key word there. I've talked about that a lot in the last few weeks, how tokenization represents a transformative innovation. Tokenized platforms with central bank reserves, commercial bank money, and government bonds can lay the groundwork for the next generation monetary and financial system. Stablecoins can offer some promise on the tokenization, but fall short of the requirements to be the mainstay of the monetary system due to three key tests: singleness, elasticity, and integrity. So again, very fascinating report. Now, one of the things that I point out in that report is that if you read between the lines, what they're basically saying there is that, hey, stable coins are not the answer because they got some issues there. They don't pass the three key tests. However, central bank digital currency, now that's the ticket, baby. That's the ticket. That's what's going to get it done. And we've got all these banks over here working on central bank digital currency. They're doing a wonderful job. And that's the piece that you're missing, folks. If you just, if you give that central bank digital currency, if you let us put that in, that's the answer to everything. Like that's the piece there that you gotta read between the lines on that. But they know that a central bank digital currency, for the most part, at the moment, is dead in the water, and people do not want it. They do not want it, and I'm thankful that most people don't want it. I don't want it. I don't want to see a central bank digital currency. I'm praying every day that this bill gets through the Senate that basically would prevent the Fed from ever creating a central bank digital currency. But we'll see what happens on that. But again, I thought this report was really interesting. And again, it gives you, always I always say this, always pay attention to what is going on at the Biz, because the Biz, it's called the Central Bankers Bank for a reason. There is this international get together, if you will, of like all the central bankers from around the world. They love to go over to the Biz and hobnob, just like they love to go to Davos, and they love to go hang out, and they love to hang out with their global banking sphere and everything. And again, the Biz is very, very influential. When you see these papers come out from the Biz, you gotta pay attention to it, because history has shown, more likely than not, whatever it is they're proposing or whatever they're putting out there usually has a way of coming into reality in the not too distant future. So I always pay very close attention to what's going on there over at the Tower of Basel. It's kind of like Lord of the Rings. It's like the Dark Lord's tower over there. Maybe not, but yeah. But anyway, all right, I digress. Okay, so on Thursday, I did episode 437, which was the growth of shadow banking and why small businesses choose non-bank lenders. So this episode examined two blog posts from PCBB titled "The Rise and Risks of Shadow Banking and Why Small Businesses Choose Non-Bank Lenders." Shadow banking has grown through technological advancement, Lack of regulation, increased demand for credit, and cost efficiency. Because of this, shadow banking poses several risks to traditional banking. Therefore, what are non-bank lenders in the shadow banking world doing right? Well, they offer relationship premiums, flexible repayment schedules, fewer documentation requirements, and faster loan decisions. So, again, just very critical for any bank out there, any traditional bank. The rise of shadow banking, basically alternative lending sources, whether it would be companies like OnDeck, Bluevine, Cabbage, even companies like Block, PayPal, Amazon that are making a lot of small business loans to small business customers out there right now. Again, very critical topic in the banking business. And also when you consider private credit, I've talked a lot about the growth of the private credit market, the dangers of the private credit market. Well, the private credit market, in a very real way, could be considered part of the shadow banking industry. And shadow banking has just grown, as I highlight in this episode, it's grown immensely. So again, if you want to learn a little bit more about shadow banking, how it is they're making all these loans right now, what's giving them a leg up in certain respect on banks or traditional banks, and so check that episode out. A lot of really good information in there. And then finally on Friday, I did episode 438. Should banks be chasing loan growth right now? So this episode reviewed 2 articles from Bank Director titled "Rising Bankruptcies Are a Warning Sign for Banks," and "Banks Should Not Chase Loan Growth Right Now." So there is a strong correlation between rising business bankruptcy filings and commercial loan write-offs. Yet, commercial delinquencies and loan write-offs remain very low. Should banks be preparing for a turning of the credit cycle? If business bankruptcy filings are a flashing red light, should banks be chasing loan growth right now? So again, very interesting question. Loan delinquency, loan write-offs are extremely low at the moment, extremely low in the banking industry. So, but could this, we've seen an increase in bankruptcy filings. Okay. Has it been like this giant leap in bankruptcy filings? Has it been so big that it's been on the front cover of the Wall Street Journal and the Financial Times? Like, no, not at all. So, we've definitely seen an increase, but is it something to panic over? No, not necessarily. So, but I do think that there, again, you have to pay attention to the turning, if you will, of the credit cycle. What does that, and what could that look like for your bank down the road? If things go sour, because I would always be the first one to say, if you're looking at any bank's loan portfolio, I'm always the first to say there is probably more embedded risk in that loan portfolio than you believe is there. Okay. And again, you could have some great chief credit officers, chief risk officers, great credit people that are taking care of their loan portfolios at their bank. And they might be really on top of it. And they might be watching things like a hawk, and they might have a very good idea of what's going on. But even despite all of that, all the analysis, the software, the tools, the people, everything else, I would always say that there's always an element of risk in that loan portfolio that perhaps you can't quite quantify. And I think that's what I think a lot of chief credit officers, a lot of risk people would tell you, that's what keeps them up at night. It's that piece that you just can't quite quantify. It's there, but you just can't quite quantify it. And the question is, and it doesn't reveal itself until you have that turning of the credit cycle. And once you have that turning of the credit cycle, and it goes bad, then it thus revealing itself. And sometimes, like I said, sometimes it's a surprise. Sometimes people peg it and they say, okay, we knew that was coming. But a lot of times it comes as a surprise. You don't really plan on it, and it's bad. So one of the things that these articles really tried to point out was to basically say, like, hey, how can you better be prepared right now for a turning of the credit cycle, or the things that you could be doing right now to help protect yourself a little bit better. And it gives a number of things in there, which I think are really good advice and some really good things to use and utilize. But like I said, those are the 5 episodes that I put out for the week. If you didn't get a chance to check any of them out, please go do so, and always like, share, and subscribe, because that always helps the channel, right? Okay. So that's what I got. All right. So let's go into some banking news. And you know what? I want to show you guys something here. As I get into this, let's let me share this. Hold on, bear with me for just a second here. All right, let's go to this. All right. So this report just came out from this work. This is a working group from the White House called Strengthening American Leadership in Digital Financial Technology. Now, I'm not going to get all crazy into this right now. I'm going to do an episode on this report because there's a lot of really good information here, but I just wanted to hit the highlights of this, and I wanted to show you here what I was talking about. So President Donald Trump's working group on digital assets markets released recommendations for digital financial technology. So the working group's recommendations include positioning the United States as a leader in digital asset markets, modernizing bank regulation for digital assets, strengthening the role of the U.S. dollar, combating illicit finance in the digital age, and ensuring fairness and predictability in digital asset taxation. President Trump in January released an executive order creating the working group to support the responsible growth and use of digital assets, blockchain technology, and related technologies across all sectors of the economy. The order also prohibited agencies from undertaking any action to establish, issue, or promote central bank digital currencies in the U.S. or abroad. So, hey, fantastic. So, like I said, I will be covering this report in much more detail. So, all right, let's get some economic indicators. So mortgage applications decreased this week. So mortgage applications for the week ending July 25th decreased 3.8% from 1 week earlier. Personal income and spending increase in June. So personal income and spending increased 0.3% in June. Mortgage rates edged down. So the rate for the 30-year fixed rate mortgage was 6.72% this week, down slightly from 6.74% last week. So, okay. ICBA opposes Circle's application for a national trust bank charter. Yes, this is big news in the banking business. So, in a letter to the OCC, ICBA said granting the charter would undermine the stability of the financial system by allowing a non-traditional institution to offer deposit-like services without adequate regulatory oversight. The OCC should reject FNDCB's application to prevent the risks posed by stablecoins, including potential deposit drainage, increased fraud, and circumvention of critical banking regulations. The OCC must undertake formal rulemaking to clarify the scope of national trust bank powers and ensure alignment with the congressional intent. So so Circle basically put in this application to get a national bank charter, and ICBA and as well as other banking organizations basically said no, they do not want to let that happen. So we will see what happens with that. Federal Home Loan Finance Agency, they proposed a repeal of the fair lending rule. So the FHFA proposed repealing its 2024 final rule on fair lending and fair housing. In the Federal Register, the FHFA requested comment on the notice of proposed rulemaking repealing the Fair Lending, Fair Housing, and Equitable Housing Finance Plans regulation. Comments on the proposed repeal must be submitted by September 26th. And ICBA will provide input. So more to come on that. Fed joins other agencies allowing alternative collection of tax identification numbers. So the Federal Reserve announced it joined other banking agencies and the Financial Crimes Enforcement Network in permitting banks to obtain a tax identification number from a third party rather than directly from customers. So the Fed said the action will grant banks flexibility in how they obtain this information while ensuring that risk-based procedures continue to underpin verification of a customer's identity. The flexibility from this action is optional. So again, just interesting there. All right, we're going to get back into the CFPB rule. I would come back to that in just a second. ICBA asks regulatory relief on debit card issuer interchange survey. So the ICBA urged the Federal Reserve to provide regulatory relief on the debit card issuer interchange survey, which is used to implement Regulation 2 debit card interchange standards. FISA and the FBI warn of scattered spider ransomware attacks. So the Cybersecurity and Infrastructure Security Agency, FBI, and foreign law enforcement groups released an updated advisory on what's called the scattered spider, a cyber criminal group targeting commercial facilities, sectors, and subsectors. The advisory provides updated tactics, techniques, and procedures obtained through FBI investigations conducted through June. CISA said scattered spider threat actors have been known to use various ransomware variants and data extortion attacks. The actors frequently use social engineering techniques such as phishing, push bombing, and subscriber identity module swap attacks to obtain credentials, install remote access tools, and bypass multi-factor authentication. Okay, Atlanta Fed details check fraud battles. So the Federal Reserve Bank of Atlanta said check fraud is a crime that's booming despite the ever-shrinking number of business checks and consumers' right. There's still billions of checks out there being used every day, so obviously a big thing. All right, let's come back to this one in just a second. ICBA supports bill to mitigate impact of the 1071 rule. So the ICBA expressed strong support for the preventing regulatory overreach to empower communities to thrive and ensure data privacy, or the Protected Act, which would mitigate the adverse impact of the CFPB's rule under Dodd-Frank Section 1071 on America's small businesses and community banks. So we'll see what happens. This bill is just being worked on right now. It's just in the pipeline. So we'll see if that comes up. But I would like to see the 1071 go away altogether. It's a whole ton of extra information, data, demographics that banks would be required to collect on small business owners. Really would not like to see that. But basically, I think in the absence of being able to fully get rid of that rule, or the implementation of that, if you could get a much more watered down version, it seems like that's what ICBA and a lot of the other banking like the American Bankers Association and so on and so forth, it seems like they're starting to pivot more toward, okay, we're not really going to get rid of it, but we're going to greatly water it down. Which, again, not super thrilled about that. I like the we're just going to get rid of it better, but but like I said, we'll keep an eye on it and see what happens there. ICBA supports a bill prohibiting SBA direct lending under 7A program. Yes, I absolutely concur with this. After Senate Banking Committee Chairman Tim Scott introduced an ICBA-backed legislation to prohibit the Small Business Administration from making direct loans under the 7A program, ICBA sent a letter of support for the Protecting Access to Credit for Small Business Act. So yes, I totally agree with that. Now, let me just say one thing on that real quick. So the SBA, I want people to understand, the SBA is not a direct lender. They have never been the direct lender. The bank is always the direct lender. What the SBA does is the SBA provides a guarantee for the bank. And the SBA basically acts as like an insurance policy for the bank loan. That's basically their role. That's what they have always done. Now, during COVID, they stepped out of that role and basically said, hey, we're going to start making what were called EIDL loans directly to customers. The EIDL loans were a total disaster for the most part. There was so much fraud. So many people got these loans. Now they can't afford to pay them back. They got bankruptcy. They got write-off. It's been a hot mess. And this is exactly why the SBA should not be a direct lender. So I am totally in favor of this. I think the SBA should just remain doing what they do best, which is a very valuable service. And again, what upsets me about it is that prior to the Biden administration, the SBA was actually a pretty well-run organization for decades, and it did a great job. And it was actually one of the few government agencies that actually stood on its own. It actually made a profit almost every year, generated profits through the SBA fees that they collected for doing the loans. And and it was one of those agencies that nobody on either side of the aisle really messed with. And then all of a sudden, the people from the Biden administration got in there, and holy, They just started, oh, we're going to make SBA a direct lender, and we're going to change all of the rules and the guidelines and the SOP, and we're going to do this, and we're going to do that, and we're going to open it up so anybody could come in and start making SBA loans. And it was not well thought out, well planned. It certainly wasn't well executed. It was horrifically executed, and it just caused a lot of problems. And now I think you're seeing the ramifications of that, and I think what has been happening is the new head of the SBA, Lori Loeffner, I think she's been doing a pretty good job. I think she's been basically just putting things back to normal, not, again, stopping some of these kind of ridiculous ideas and just getting the SBA back focused on what they do best, which is a good thing because they run it well and they make good money for the taxpayers. So which you cannot say about many of government organizations. So again, I hope that sticks. So, okay. ICBA opposes Nissan's ILC application. So ICBA urged the FDIC to reject Nissan's deposit insurance application for its proposed industrial loan company, Nissan Bank. Nissan Motor Acceptance Company, the financial services arm of Nissan North America, last month submitted an application to the FDIC and the Utah Department of Financial Institutions to form an ILC based in Salt Lake City. Nissan said the proposed ILC would focus on commercial financing for dealerships. ICBA is in opposition to this and does not want to see it. And I have reported extensively on the ILC charters and applications. If you guys want to get more information on that, go back and see the couple episodes that I did on the ILC charter. I think you may find them very interesting. Okay, then CISA updates alert on SharePoint vulnerabilities with new Microsoft guidance. So the Cybersecurity and Infrastructure Security Agency updated its alert on vulnerabilities with Microsoft SharePoint servers to reflect newly released information as threat actor tactics, techniques, and procedures continue to evolve. So CISA said the update contains additional information on the development of ransomware, new web shells involved in exploitation, and enhanced detection guidance. So that is coming out from CISA. Obviously, Microsoft had a lot of issues through SharePoint, and now they're working on trying to get a lot of that stuff adjusted. So, okay. All right, let me switch over here. Give me 1 second here, guys. I'm going to bring our articles back up because I want to talk about what happened with open banking this week. So a lot happened this week with open banking, otherwise known as the 1033 rule. So, all right, before I get to this article, I just had to read these other two headlines here. So, ICBA and others correct the record on the CFPB's 1033 rule. So, ICBA and other groups issued a statement correcting the record on the Consumer Financial Protection Bureau's Section 1033 rulemaking following misleading claims from a group of fintech and retail organizations. So, in a recent letter, the Financial Technology Association and other groups urged President Donald Trump to uphold the CFPB's 1033 rule on consumer data security and privacy after the Bureau last month asked a federal court to vacate the rule. In a national news release, ICBA and other groups corrected several inaccuracies from the letter while noting the rule would put Americans' most sensitive financial data at risk. Yes, absolutely. Okay, so that happened, and then this happened. So CFPB says it will rework the 1033 rule. The Consumer Financial Protection Bureau requested a stay in a lawsuit challenging the 1033 rule on consumer data security and privacy and said it plans to craft a new rule soon. And that's what brings us here to this article now. So the CFPB to substantially revamp open banking rule, it says a judge stayed a court case challenging the rule after the Bureau said it would re-examine the matter and find a well-reasoned approach that aligns with the policy preferences of new leadership. So So here's the bullet points on this. So the Consumer Financial Protection Bureau will substantially rework a U.S. open banking rule, it said Tuesday in a court filing, prompting a federal judge to stay proceedings in a lawsuit that banking associates filed last year to block the measure. In light of recent events in the marketplace, the Bureau has now decided to initiate a new rulemaking to reconsider the rule with a view to substantially revising it and providing a robust justification. CFPB attorneys wrote in their motion to stay the case. The Bureau faced a Tuesday deadline to reply to a filing from the Financial Technology Association, which has intervened to defend the 2024 rule. The agency plans an accelerated rulemaking process and said it would issue a rulemaking notice within 3 weeks to begin drafting a new rule. Judge Danny Reeves of the U.S. District Court for the Eastern District of Kentucky granted the stay request, telling litigants to update him every 45 days. Now, before Reeves' decision, the Financial Technology Association told the court it did not oppose the Bureau's request. By contrast, the bank plaintiffs opposed halting the litigation. In May, Reeves ruled that the FTA could intervene in the suit to defend its members' interests. The FTA will participate in the rulemaking process in good faith in the hopes of achieving a solution that upholds consumers' fundamental right to their financial information. For fintechs, the fate of U.S. open banking gained new urgency over the past month as JP Morgan Chase informed several data aggregators of new fees for access to consumers' financial information. Such fees, if widely adopted, could add hefty costs for fintechs seeking to handle transactions and lure customers away from banks. New fees could also hamper the growth of cryptocurrency enterprises and risks the future of fintech digital assets and America's financial innovation and global leadership. 10 associations wrote last week in a letter seeking President Donald Trump's help with the issue. We're glad the CFPB recognized that financial institutions will take advantage of regulatory uncertainty and that consumers must retain the right to access and share access to their own financial data. Steve Baums, executive director of the Financial Data and Technology Association, said in an emailed statement. Now, I just want to point out here, when they talk about the fees, and if the fees are widely adopted, could add hefty cost for fintechs. So in other words, what they're mad about is that they're not going to get this, they're not going to get their hands on your data for free, for nothing. Okay, which is absolutely ludicrous, and it just tells you that this has absolutely nothing to do with the consumer. Forget about consumer rights. This has nothing to do with consumer rights. It is the fintechs wanting to get their hands on your data for nothing. Okay, that's what this is about. Okay, and they give you all this garbage and all this hot talk about oh, it's about consumer rights and it's going to give you more control over your data. Please, somebody explain to me how giving my data to Google or Meta or Amazon, how does them having all my bank data, how does that give me more control over my data? Please explain this to me. Explain this to me like I'm a 5-year-old, okay? Because I don't get it. I don't want, who I want to have my data? I want my bank to have my data because it's private, and I want the bank to keep my data private. I do not want my data going to somebody else. Period. End of story. For no reason. And this is a major, open banking. I do not want open banking for any reason. Now, and the big troubling thing this week, as this article points out, is that basically, JP Morgan and then PNC came out and basically said, hey, you know what? I think we're just going to start charging for this data. And furthermore, I think we could be okay with open banking if we got paid for this, and now you got the CFP doing an about face going, okay, we're not going to kill the rule. Now we're going to go back and rewrite it, because now if we could just give the banks a profit motive, and as long as JP Morgan can make a few more $1 billion selling all of their customer information or selling the information that they don't deem valuable, then hey, all the power to them, right? And now, and while I was the first to say, and I've spent a lot of time talking about open banking, the open banking rule. I've done episodes on it leading up to it. I had four big items this year, regulatory wise, that I wanted to see shut down. I wanted to see beneficial ownership information. I wanted to see open banking. I wanted to see the 1071 rule. I wanted to see the CRA, Community Reinvestment Act. And things were going real good to start the year. BOI got squashed, at least the database, the BOI database that they wanted to create, that got squashed. But then, but it's still, banks are still collecting BOI information. Then it looked like 1071 was going to get completely crushed. Now it looks like it's not going to get crushed. It's still going to go in, but it's going to be a little bit more watered down. Looked like 1033 was done. Looked like that was dead. That was going to get repealed to take it back. Now they're going to go back and rewrite the rule, and it's going to come back. And I'm, like I said, I'm terrified of what this comes back to. And again, going back to this nonsense of the new fees could also hamper the growth of cryptocurrency enterprises. How? Like, I'm sorry, I didn't realize that every bank in the country was offering digital wallets and holding digital assets for people and allowing stablecoin for payments. I didn't realize that all that was already happening. None of that is happening yet. It's coming. The regulation's being worked through right now, but it ain't here yet, and banks aren't doing it yet. So, so this idea that, all these new fees are going to hamper all this, whatever. It's, again, I am vehemently opposed to open banking. Nobody is going to win with this. It's not going to work. It will never work for the consumer as they say it is going to work. It never will. This idea that you're just going to be able to easily switch banks and do whatever. First of all, people don't, contrary to popular belief, people do not switch banks that often. They do not. People, it's every once in a while people will switch bank accounts. Now you might have bank accounts at multiple banks, but you're not switching you're not switching banks every month, every year, every couple of years. It's just people don't work like that. They don't want to have, if you get, especially if you get direct deposit, if you got all kinds of ACHs and things coming, you got gym memberships, all kinds of other nonsense coming out of there. You don't want the hassle of switching that over. Believe me, I've been there. I know. And then the other thing is it okay? So I have the data, and then we go to open up an account. Does that just mean that I don't have to follow, know your customer, CIP, EDD, EDD, all these bank regulations that fall under, BSA and AML. I don't need to follow any of that stuff anymore when I'm opening a bank account or a deposit account for a consumer or a small business owner. I don't think so. You're still going to have to follow all that stuff. Okay. It's not going to speed anything up. It's not going to make anything faster. It's a delusion, but what it will do is it'll make the fintechs a ton of money, because they'll be able to sell your data in all different kinds of ways. Okay. It'll make this fintechs very happy. It may make some banks very happy. Like if they could sell your data and turn it into a continuous revenue stream, that may make some banks out there happy. I don't know how happy it's going to make their customers, but it may make them happy for a little while anyway. So again, I'm just not, I don't think the people that, and again, you have to remember something. Google and Meta and Amazon and OpenAI, these guys have sat there for years and have salivated. They have salivated about they want to get into banks. They want that data. They want that treasure trove of data. They have an insatiable appetite for it. They want to get their hands on it. And here's the other dirty little secret with open banking, okay? So and again, I don't know, whatever you want. Call this the conspiracy theorist in me, whatever. But I'll lay it out to you like this, right? So open banking goes through. Google comes in, goes to JP Morgan, says, "Hey, all these customers said we could take all this data, so we're going to take all this data now." Okay, so they come in, they take all this data out, right? Now, the government. So say the government comes in and goes, you know what? We would really like to know how many customers there at JP Morgan are buying guns every month. We'd like to know what political parties they're donating to. We'd like to know, how they're spending their money in certain ways. So now, can the government just go in and arbitrarily do that? No, they can't, because they need this little thing called a warrant. Okay. And in order to get a warrant, you have to have some kind of evidence or probable cause. You got to take it to a judge. Now, they could take it to the FISA court, which is secret. And that's what they usually do to get all their dirty stuff rubber stamped, is why the FISA court is just disgusting and needs to go. But again, if you were coming into a regular court of law, you got to come in and you got to show a judge evidence. And you got to get a warrant, and then you can go to the bank and you can present your warrant and say, hey, we want such and such as data. Okay. That's not going to work if you want everybody's data, because that's a violation of the Fourth Amendment. It's a violation. And again, this is the court case that was filed against open banking. Remember the National Small Business Association? Yeah, they filed a lawsuit against the CFPB last year, claiming that open banking was unconstitutional. You know what happened? They won their case. The judge said, oh, yeah, this violates a number of constitutional amendments. Not just one or two, a number. So that's already happened. That's already been through. So, so again, we're seeing some of this stuff play out, and so the government could basically do a backdoor. The government could then go to Google and just buy the data. They could just pay for the data and just say, hey, Google, we want it. And then now it's not a violation of your privacy. They're not violating anything. They haven't broken any laws, because they can go back and say, hey, we just purchased the data from Google or from Meta or from Amazon. Okay, that's the dirty little secret here. That's why do you think the government was like? Why do you think the CFPB was so gung ho on forcing this? This is not legislation. This is not a law. Congress did not pass this, and CFPB just proposed this out of nowhere and just came in and said, yeah, you know what, we're doing this open banking rule. We're going to throw this in here, and and a lot of people were sitting there going, well, gee, that's interesting. Why would the government or a government agency just come out of nowhere and just present this rule and just basically force every bank in the country to just allow companies to come up and siphon your data out? Well, if the government wants to find out everything you're doing and they can't do it legally, they'll find an end around. And that's part of what I think this is. Can I directly prove that? No. But it's just, we've seen enough. We've seen how many crazy things have you seen in the last, 10, 20, 30 years of government overreach and government doing unscrupulous things that it shouldn't have been done. You see it every day. You see it every single day. And so that's what. So again, that's why I am vehemently opposed to open banking. I don't want the rule rewritten. I want this thing crushed. I want it gone away, and I don't want it to ever come back. That's just how I feel about it. I feel very strongly about it, and that's And again, if people are smart and if people study this subject, I think they will come to the same conclusion. If you study the finer points of this rule, this 1033 rule, I think you will come to the same conclusion that I do. That basically like, no, I don't want this. I don't want this. I don't need, like I said, don't need all these big fintechs and big tech getting all of my bank data. I'm sorry, I don't need them. I don't need Google to know when I go shopping and when I go to the food store and what I buy at the food store and everything, and how often I go. They don't need to know that. They don't need to know that. I'm sorry, period. Don't need to know it. They could cry and scream and kick all they want. Sorry, not going to change my mind. All right. Now I've done my whole open banking diatribe here. Let's move on to some other. I've got a lot of other stuff to run through here. So, the Trump admin to change citizenship tests and the H-1B visas, officials say. New USCIS director said the test is too easy, vowed tougher standards to become a naturalized U.S. citizen. So again, I just think that I'm not going to go into this whole thing here, but I just think I wanted to keep an eye on this, and I wanted to report everyone because I think the H-1B visa thing has become, I think, in the last couple of months, a big hot button item. And we'll have to see what happens with this and how this plays out. There are obviously people on both sides of this argument. There are the big tech side, which basically says, hey, we need this because we're bringing in, the smartest people, supposedly smartest people from around the world. But then you have people on the other side of this argument that basically says that, like, no, this idea that you're bringing in the best and the brightest is a joke. You're basically just doing this for cheap labor. You're exploiting these people. You're bringing them in, and basically the American who should have that job, you're taking that job away from them, and you're giving it to a foreigner who's going to basically work for less and work like a dog. And to stay here basically because, hey, this is a million times better than what they got wherever they're coming from. So you got some different sides to this argument. And I would say that the truth is probably somewhere in the middle, because I see truth on both sides of this thing, right? So again, it's just another thing to keep an eye on, and we'll see how that plays out. So, okay. This was interesting. Ex-Flagstar CEO accused of illegal conduct. So a former compliance executive at the bank sued Alessandro Danello, saying the ex-CEO knew of a client's money laundering and discussed sensitive information while a junior employee sat on his lap. Former Flagstar CEO, I was going to say Mr. Danello, is accused of allegedly being aware of a client's money laundering activities and discussing sensitive company transactions over a virtual conference with a junior employee sitting on his lap. The complaint was filed Tuesday by Ross Maranzo, the one-time enterprise chief compliance officer at the bank, who was terminated before he could conclude an investigation related to money laundering and insider trading allegations and report the findings to the appropriate government entities, according to the lawsuit. While Maranzo investigated and raised many clear ethical complaints as part of his role, his termination was a brazen attempt to block an investigation into Mr. Danello. Maranzo's lawyers wrote in a lawsuit filed in the U.S. District Court of Eastern District of New York. Maranzo, a 40-year veteran in the regulatory compliance field, worked at New York Community Bank, which merged with Flagstar in 2022 and adopted the Flagstar name last year. At NYCB, he monitored the lender's ethics program and was involved in reviewing ethical violations and breaches related to federal laws and regulations. In March of 2023, New York Community Bank bought a large segment of the failed Signature Bank for nearly $2.7 billion. In March of 2024, as New York Community Bank faced financial problems, the bank's CEO resigned and the board installed Danello as chief executive. Danello has been serving in a non-executive capacity, but Danello's tenure as New York Community Bank CEO was short-lived. He stepped down in April of 2024 when Joseph Otting took the helm. Following the leadership changes, Maranzo, who had previously led remediation efforts for Signature Bank's regulatory issues, headed multiple investigations involving Danello, the lawsuit noted. So again, New York Community Bank had a ton of problems. They were about to go under, and basically they had to have a bunch of investors come in. They got $1 billion capital raise. I mean, pretty extraordinary. $1 billion capital raise. Basically, like you said, Danello got fired. Obviously, they obviously, based on this, obviously because they thought that there were some highly unethical things going on there. Now, Joseph Otting, who is a former regulator, very well-respected gentleman in banking circles, has taken over and would appear to be doing a pretty good job of straightening things out over there. But, again, New York Community Bank almost blew up in spectacular fashion, had a lot of problems. They've now adopted the Flagstar bank name. They're not going by New York Community Bank anymore, obviously because of the damage done to that brand. So they're just going under Flagstar. And they basically, I basically went over an article last week where they want to now get rid of their holding company, which is again, very unusual, not something you usually see or not something that a lot of banks are really doing right now. So again, just another, kind of interesting thing. But I will follow this story, and we shall see where this leads. If Mr. Janello ends up being in really hot water here, but we'll see. America's bank account balances are flat. Why that's not alarming. So balances in checking and savings accounts have been growing more slowly than expected over the past year. However, consumer cash balances are better when included investments, indicating that many transfer money from their bank accounts to investments. Many consumers are likely taking advantage of higher interest rates on investments like certificates of deposit and high yield savings. So bank account balances in the U.S. are lower than expected, but that's not necessarily a bad sign. Over the past year, households have held less in their bank accounts than what historical trends suggest they should, according to JP Morgan Chase, which examined 4.7 million Chase households. In May, the median bank balance had increased by 23% from 2019, however, far below the 40% jump analysts expected. So just, again, very interesting to keep an eye on this. But yeah, I would agree with the underlying thought that, yeah, a lot of people are holding a lot of money right now in investment accounts and CDs and other, high yield accounts that are at least probably getting them, 3-4% interest right now. That's what I would assume anyway. Consumer confidence improves in July as inflation fears dip. So consumer confidence as measured by the Conference Board rose in July. The reading comes after the index declined in June as worries over the labor market persisted. Consumer surveys have improved recently after falling in the wake of President Donald Trump's tariffs announced in April. So again, consumer confidence improves in July, which is good. A couple of credit card related articles here. So credit card users are cautious now. Rate cuts could open the floodgates. So most Americans are managing their credit cards well right now. So slashing the cost of using them could unleash spending. So what is holding back Americans from borrowing more to fuel spending probably isn't their level of debt. It's the cost of it. As debate rages about whether the Federal Reserve should slash borrowing costs and how soon, the state of the consumer will be a key question. Some of the latest data points suggest that many consumers, particularly low-income households, are slowing their spending, but could, in theory, borrow more on their credit cards to keep it going. So again, I don't know if we want to be going with that. I mean, I think we're sitting at, average credit card interest rates are hovering up around 22.5%. Okay. Still pretty high. That's to be expected. But I mean, what is total credit card debt right now? Like 1.4, $1.5 trillion. I mean, it's insanely high. I mean, it's at record levels right now. I don't think that we really want more credit card debt at the moment. I don't really think that's the answer. Now, while I do agree with the premise that if you lower rates, people will naturally go out and spend more on their credit cards, to be sure. But is that really what we want to be doing? That's the question. Credit card annual fees are going up. Are they still worth it? So credit card issuers are raising the annual fees on their premium products to the tune of hundreds of dollars. Chase, most notably, upped the yearly charge for its popular Sapphire Reserve from $550 to $795 in June of 2025. But it's not the only issuer with increasingly pricey plastic. Learn more about the recent fees. So key takeaways. So premium travel credit cards are inching closer to costing cardholders $1,000 a year, with the Chase Sapphire Reserve now charging $795 annual fee as a publication. These cards offer robust benefits, including airline and or hotel credits, concierge services, and more, but you must spend or travel enough to fully leverage them. Issuers charge high annual fees to subsidize benefits, compete with one another, and ultimately turn a profit. You can determine if an annual fee is worthwhile by calculating your spending against the rewards return and assessing how easy it is to redeem the card's benefits. So again, just very interesting. So if you travel a lot out there and you're using your card a lot to keep your rewards cards, your really good rewards cards, and American Express is no they're no consolation. I mean, their price has got to be right up there with whatever Chase is doing with the Sapphire, reserve. So again, just very interesting. Just something I thought, keep an eye on here. Okay, Trump appointed group calls for clear crypto regulation, tax changes. That was the report that I showed you guys earlier. The long-awaited 160-page report detailed regulatory and legislative suggestions in the interest of the new American golden age. So, like I said, I'm not going to go into that now. I'm going to, because I want to do a whole episode just on that report. I want to give that report its own due. So, like I said, but I'll come back. I'll let you guys know. Hopefully, I'll have that report out hopefully I'll have that episode out in the next week or so to cover that. Okay. This is interesting. JP Morgan teams up with Coinbase. So the U.S.'s biggest bank will partner with the crypto exchange to link Chase bank accounts and Coinbase crypto wallets. So JP Morgan Chase has partnered with cryptocurrency exchange Coinbase, aimed at making buying crypto easier for the bank's customers, the company said Wednesday. So the initial phase of the partnership gives customers of both companies new capabilities, such as direct bank-to-wallet connection, which enables JP Morgan customers to link their bank accounts to Coinbase wallets using the lender's application programming interface. Chase is also allowing customers to transfer their Chase Ultimate Rewards points directly to Coinbase accounts with a 1-to-1 redemption ratio, 100 points equal to $1 in value, and use their accumulated rewards points to fund their Coinbase accounts. So very interesting. So, keep an eye on this one, ladies and gentlemen, because this one will in fact be will be very interesting as we go forward. All right, I am kind of running out of time here, and I had a lot left that I wanted to run through. So some of this stuff I could run through very quickly. So let's take a look at I just wanted to go over some earnings real quick here. So Robinhood just reported a blowout quarter. So Robinhood had obviously the trading app, phenomenal, second quarter earnings here. Robinhood market shares moved higher. On Wednesday, after diluted earnings per share and revenue materially exceeded expectations, the online trading platform said its stellar results were driven by higher trading in options, crypto, and stocks. So there you go. SoFi technology stock jumped on second quarter results, raised its outlook. So SoFi technology shares are jumping 15% in intraday trading Tuesday after the personal finance tech firm posted better than estimated results and boosted its revenue and earnings outlook. The company is a favorite among retail traders. So there you go. Meta, Microsoft roar higher on strong earnings as AI spending booms. So share of Meta and Microsoft popped after reporting strong earnings that beat analyst expectations. Meta and Microsoft have been investing heavily in AI infrastructure in recent years, and they will continue to shell out billions in capital expenditures. Microsoft officially tops $4 trillion in market capitalization, joining NVIDIA in this exclusive club. So Microsoft stock climbed after reported strong earnings, pushing the company's market cap past $4 trillion. That's amazing. The software giant reported better than expected quarterly results and said Azure's annual revenue topped $75 billion. So Azure is that's their cloud service, the cloud end of the business. NVIDIA became the first company to reach the $4 trillion mark earlier this month. Okay, quick article here. Federal student loans shrank under the Big Beautiful Bill. So the one Big Beautiful Bill reduces both the dollar amount and the type of federal student loans that many students could take out on or after July 1st, 2026. In particular, it shrinks the type of loans that graduate students can take out, but increases the loan limit for professional students, such as those studying medicine or law. The bill also establishes a lifetime loan limit for all college students and reduces the amount of loans parents could take out to help their child pay for college. Now, a lot of people will probably look at this and say, oh, that's horrible, because how are people going to pay for school now? No, what this is designed to do, it's designed to try to finally get control of the cost of college. Like, in other words, if people are going to sit there and go, hey, I got X amount of dollars, I can get this amount of student loans. That's all I got. And if I can't afford to go here, I'm not going to go here. I'm going to go somewhere else. So what this is going to do is this is going to force colleges. Now, anybody who studied colleges over the last, 30, 40 years knows that the increasing costs, the annual costs of college have far exceeded inflation. I mean, far exceeded. I mean, if inflation was running at 4%, the cost of college is going up every year by 15%, 17%, 20%. I mean, it's just absolutely ludicrous. And the reason why the costs of college keep ballooning every year is because the government keeps the spigot rolling. They keep the spigot wide open. They'll just fund whatever loans kids need to go. And so colleges feel like they got a blank check. They can just write the check, boom, and off it goes. So obviously that is a big part of what they're trying to do here is they're trying to cap the cost. They're trying to get the cost back under control so that college, not to stop the growth of college tuition, but just to get it to increase at a normal pace. And it'll take a while for all this to work through, but that's ultimately what they're trying to get at here. Another one, millions of student loan borrowers could see their debt grow as interest-free break ends. So borrowers who remain in the so-called SAVE forbearance could see their education debt grow by $219 a month now that interest accrual is resuming, according to one expert's calculations. Most borrowers will be better off quickly finding a new repayment plan. Yes, I would say so. Here's another interesting article. JP Morgan marks 1,000 branch openings since 2018 expansion plan. So JP Morgan has built 1,000 new branches in the last 7 years. So pretty interesting. So again, the death of the bank branch is, I'm trying to think of Mark Twain's famous quote. The announcements of my death have been greatly exaggerated. So the death of the bank branch has been greatly exaggerated. The bank is marking the milestone opening in Charlotte, North Carolina, Thursday, where Chairman and CEO Jamie Dimon is attending a ribbon-cutting ceremony. The firm has roughly 5,000 branches, the most of any American bank, according to Federal Reserve data. So while I will tell everybody that bank branches hit their peak of about 97,000 bank branches, and that has been coming down. I think we're down to about 75 or 76,000 bank branches in the country right now. And that number does, and I think that number will continue to go down. But again, this idea that like the bank branch is dead and it's going away or whatever, no, I can assure you the bank branch is not dead. It's not gone, and it's not going away anytime soon. Okay. Yeah, I had a bunch of other stuff that I wanted to jump into. Let me do this real quick. Tesla and Samsung signed a $16.5 billion deal to make AI chips. So those are interesting. Chips will be designed for AI data centers, autonomous driving, and robots. Shares in South Korean tech giant surge. So Samsung will manufacture AI chips for Tesla in Texas under a multi-year $16.5 billion deal. Tesla's A16 chip will be used in humanoid robots, self-driving cars, and AI data centers. Samsung shares rose 6.8% following the news, closing at the highest level since last September. So Samsung Electronics will manufacture artificial intelligence chips for Tesla in Texas under a $16.5 billion multi-year deal, a major win for its U.S. foundry business that sent shares of South Korea's largest companies sharply higher. Tesla chief executive Elon Musk confirmed the deal on X, saying Samsung's new facilities in Texas will be dedicated to making the U.S. electric vehicle company's next generation AI6 chip. The strategic importance of this is hard to overstate, he wrote. So again, very, very interesting news there. So, all right, I had some other stuff, but this will probably have to wait till next week. So, okay, I'm gonna wrap up here real quick. I'm gonna do my story of the week and our quote of the week. I also but before I get to that stuff, I just want to say a couple of things here, a couple of notes real quick. If if anybody is listening on, is anybody listening to the podcast on Apple Podcasts or Spotify, please leave me a review. I could really use the reviews, could really help. I have gotten a few reviews on Apple Podcasts, which is great. If people could keep doing that, I would greatly appreciate it. I think next week I'll probably read some of those reviews to everybody because I thought some of them are really nice. It's a couple of them are kind of funny. So I thought I'd read a couple of those next week. So again, if you're listening to this on the podcast on Apple Podcasts or Spotify, please make sure to leave a review. It would really help me out. If anybody wants to follow me on YouTube, I would suggest that you do, because I actually put up posts. Basically every Sunday I put up a post. I say, hey, here are all the episodes that are coming out this week, Monday through Friday. If the strategy room gets moved for whatever reason to a different night or different time, I always put a post on YouTube so you could follow those posts and kind of get a little bit more up-to-date information as to what's going on. If anybody has not had a chance, I do have a website for the podcast, www.thebankernextdoor.com. A lot of great stuff there on the website. You can find any past episodes on there, or at least links to past episodes, whether you're listening to the podcast or YouTube or Rumble or whatever the case may be. You can find stuff on there, as well as articles, news, all kinds of other information and stuff that's on the website. So please, if you get a chance, go check out thebankernextdoor.com. What else? Was there anything else I wanted to hit on those topics? I don't think so. I think that was all I had for the moment. Working on a lot of other stuff coming in the weeks ahead. I've got, working on a lot of different interviews, working on a couple of different new series, like a CEO series that hopefully, well, like I said, we're working on a couple of things right now. Might be doing a couple different things there. I'm working on kind of a financial history series that I'm hoping to do with somebody else, hoping to have a co-host with that. So we'll, like I said, I was going to launch that earlier this year, but it just I couldn't get it exactly the way I wanted it to go. So I kind of put it on the back burner, but I've recently been able to work on some stuff. So like I said, I'm hoping I could kind of bring that to everybody in the next few months, but we'll see. I'll keep you posted on that. But I think that's all I got so far. So all right, let's go to our story of the week. So, and again, I do this every week. I've touched on some of the more recent ones, like I did the London Metal Exchange, Federal Trade Commission, Federal Deposit Insurance Corporation. Now I'm just going to do stock market. So the stock market broadly refers to the collection of exchanges and other venues where the buying, selling, and issuance of shares of publicly held companies takes place. Such financial activities are conducted through institutionalized formal exchanges, whether physical or electronic, or via over-the-counter, what's known as OTC marketplaces that operate under a defined set of regulations. While both the term stock market and stock exchange are often used interchangeably, the latter term generally comprises a subset of the former. If one trades in the stock market, it means that they buy or sell shares on one or more of the stock exchanges that are part of the overall stock market. A given country or region may have only one or more exchanges comprising their stock market. The leading U.S. stock exchanges include the NYSE and the NASDAQ. These leading national exchanges, along with several other exchanges operate in the country, form the stock market of the U.S. So that is the U.S. stock market. Okay. So now let's go to our quote of the week. So, all right, everybody ready out there? Okay. So, nothing in this world can take the place of persistence. Talent will not. Nothing is more common than unsuccessful men with talent. Genius will not. Unrewarded genius is almost a proverb. Education will not. The world is full of educated derelicts. Persistence and determination alone are omnipotent. And that was from Calvin Coolidge. And I love that quote. It's great. Basically, persistence. It's all about persistence. And it's kind of funny. I just saw an old interview with Steve Jobs where he talked about persistence, and almost the persistence to the point of almost seeming insane, because he said a sane person would give up. But he said, but the difference is always persistence. It's not necessarily how smart you are, how talented you are, how much education you have. It's just persistence at the end of the day. Never, ever, ever give up. So, all right. Well, that is the podcast. I really enjoy doing this every week with you guys. I thank you so much for hanging out with me on this Saturday night. I really appreciate it. I would basically say, if you're liking what you see, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments, as I always love getting comments from everybody and trying to answer all your questions and everything that I get so often. And I would just say, please remember, check out some of the other content on the channel. If you've never checked out the crypto series or the Lords of Easy Money series, or any of the interviews that I do, which are now I've done quite a number of, please go check those out. There's a lot there. Go to YouTube. I've got everything categorized. Everything's laid out nicely. You can find business book reviews, business reviews of business related movies and documentaries. I've got a couple of those up there. I've got a lot more that I need to do. So again, a lot of great stuff out there on the channel. I hope everybody gives it a chance, goes to check out the content. But for those that are listening and following, I can't thank you enough. I appreciate it. Really appreciate it from the bottom of my heart. But with that being said, have a great night out there. Enjoy the rest of the weekend. I will see you guys back here next Saturday night at 8 o'clock for another episode of the Strategy Room. Have an awesome time out there. I'll see you again real soon.